Let me start with a question. Would you rather own the entire haystack or spend the rest of your life searching for the needle? That might sound like an odd investing question, but it sits at the heart of one of the biggest decisions investors make. Should you try to beat the market, or should you simply own the market? Today, we're going to compare two popular approaches to investing: index funds and actively managed funds. Let us start with an index fund. An index fund doesn't try to predict which companies will be winners and which companies will be losers. Instead, it simply owns all the companies in a particular market index. For example, an S&P 500 index fund owns shares of approximately 500 of America's largest publicly traded companies. Companies like Apple, Microsoft, Amazon, Johnson & Johnson, Coca-Cola, and hundreds of others. Rather than trying to guess who will win, the fund owns them all. Think of it like owning a small piece of the American economy. As businesses grow, innovate, and earn profits over time, investors participate in that growth. Now let us compare that to an actively managed fund. An actively managed fund has professional managers making investment decisions. Their job is to identify opportunities they believe will outperform the market. They research companies, analyze financial statements, study economic trends, and attempt to select investments that will generate better returns than a simple index fund. At first glance, that sounds pretty appealing. After all, if professionals are spending their careers researching investments, shouldn't they be able to outperform a simple index fund? Sometimes they do. The problem is consistency. The challenge isn't finding a manager who beats the market this year. The challenge is finding one who can continue doing it year after year, decade after decade. And that's where things become difficult. Numerous studies have shown that over long periods of time, most actively managed funds fail to outperform comparable index funds. Notice those last four words, after accounting for fees, because fees matter a lot. Let us look at a simple example. Imagine two investors. Both earn the exact same investment return before fees. One pays very low expenses through an index fund. The other pays higher expenses through an actively managed fund. Year after year, those fees quietly reduce the return available to the investor. The difference may seem small in any single year, but over decades, small costs can grow into very large amounts of money. That's one reason many investors choose index funds. They are generally simple, low cost, tax efficient, highly diversified, and easy to understand. Now let us be clear. This doesn't mean all actively managed funds are bad. Some managers have produced excellent long-term results. Some investors prefer active management, and there may be situations where an actively managed fund makes sense. The point isn't that one approach is always right. The point is that investors should understand what they're paying for and what they're likely to receive in return. This discussion reminds me of something Warren Buffett has said repeatedly. He has often suggested that most investors would be better served by owning a low-cost S&P 500 index fund. Jack Bogle, the founder of Vanguard and creator of the first index fund for individual investors, said it even more simply: don't look for the needle in the haystack, just buy the haystack. I love that quote, because investing doesn't need to be complicated. You don't need to predict the next great company. You don't need to guess which manager will outperform. You don't need to watch financial news all day. You don't need to become an expert stock picker. You simply need a sensible plan and the discipline to stick with it. Now open your workbook. In the Lesson 6 section, you'll find links to several studies and resources. Take a few minutes to review them. Then answer this question: which investing philosophy best matches your personality and goals? Do you prefer simplicity and broad market exposure, or do you feel more comfortable relying on professional managers to make investment decisions? There isn't a perfect answer, but understanding the difference will help you become a more informed investor. As we continue through this course, you'll discover that successful investing is usually less about finding the perfect investment and more about consistently following a good plan. In the next lesson, we'll explore another important investing decision: ETFs versus mutual funds. They're often built from the same investments, but the way they work is surprisingly different. I'll see you in the next lesson.